Hello and welcome. Today we will explore coupon rates and currency denomination. These elements define the cash flows and risk for the investor. So let's get started. So coupon rate, which is also known as the nominal rate, right? This is the interest rate that the bond issuer promise to pay you every year until the bonds mature. To figure out exactly how much money you will receive, you simply multiply by coupon rate with the bond's par value or face value, which is usually it's a face amount, also known as par value or capital. For instance, if you hold a bond with a par value of $1,000 and coupon rate is a 6%, the issuer will pay you $60 as an interest per year. This fixed income is a key reason why as a bond you would trying to invest, because it gives you the regular cash flows, continuous money, even it's a lower compared to the equity market and other, but it's a steady income which as an investor you want to have it. Now moving to the next is a let's understand what is the difference between fixed versus floating rate bonds. Sorry, coupon payment frequencies first we will discuss, then we'll move to the fixed and floating rates. Now while the coupon rate tells you the annual amount, the annual amount, the payment frequency tells you when you get paid. So there are various type of payment frequencies which depends on the different type of market. For example, if you are investing in a German government bonds, which is also sometimes known as the bunds, bunds, you typically receive one payment per year, which is annual frequency. However, in the US and UK market, the payment frequency is coupon frequency is semi-annual. So based on that, your yield will change. We'll discuss later on that. But this is the half yearly coupon payment would be done to you. Some specialized securities like mortgage-backed securities, also known as MBS, which is securitized product, pay you quarterly or monthly to match home owner payments. We'll discuss when we discuss about the advanced courses. So in this timeline, which you can see like how do you get the payments. Now let's talk about the fixed versus floating rates. What exactly is the difference? So most bonds are plain vanilla bonds. What does it mean? They pay you a fixed interest rate that never changes. This is your fixed bond. However, some bonds called floating rate bonds or floating rate notes, FRNs, have variable coupons. What does that mean? For an FRN, the interest rate is reset periodically. Okay, based on the market reference rate. What is market reference rate? Previously it was the LIBOR. So what does it mean? LIBOR plus a fixed spread would be paid to the investor. So let's say 4.75 is a coupon rate of your LIBOR rate, and it is decided on this bond. 0.35 would be the spread. Then in this situation, 5.10 would be the coupon rate. If LIBOR changes from 4.75 to 5%, then your coupon rate would also change, which is 5.35 in that case, correct? So the coupon on the FRN goes up to, as we discussed, keeping the bond price relatively stable compared to a fixed rate bonds. Now let's move to the zero coupon bonds. What is this? Is a unique type of bonds, which is a zero coupon bonds. It pays you the zero periodic interest. Instead, you buy these bonds at a deep discount, meaning well below their face value. Suppose the face value of the bond is $1,000, then you for 10-year bonds you may pay only $600 while investing in that bond. So your return comes when your bonds would get mature. For example, in this scenario, let's take a $600 is the bond. You paid for a $1,000 bond. At the 5 year, the value of this bond is an $800, which is an accrued interest, which is a you can say like $200 got accrued. Now next is your 10-year. When 10 years completed or when your bond matured, you will get the $1,000. So initially you invested $600, but $400 is your profit or your gain. Basically, I wouldn't say profit; it would be a gain, correct? Because it's $1,000 you will get after 10 years. Now let's move to the currency denomination basics. What does this mean? Moving on to the currency, bonds can be determined by in any currency. Now the US dollar and the euro are the most common globally when we talk about currency. The choice of the currency affects how attractive a bond is to an investor, and based on the liquidity and exchange rate volatility. So issuer often sell bonds in a foreign currency if they have a revenue in that currency, creating a natural hedge. For example, a Japanese company with the US sales might issue a dollar denominated bond to simplify its payment.